Hello everyone. So that is going to be this is going to be the last session on equity securities. So with this we are done with valuation of equity securities, and we move on to fixed income securities starting from next class. So I'm going to get back to where we stopped. We were talking about various price multiples and how do we calculate price multiples, how do we interpret them, and how do we make a decision whether a stock is undervalued or overvalued. So in the absence of any other information, as we discussed yesterday, when you talk about price multiples, if you have lower multiples, whether it could be price to book or price to earnings, price to sales, or whatever multiple that you are looking at, if your multiple for a particular equity instrument is lower than the industry average or a nearest competitor, we consider that investment to be undervalued. And if your multiple is more, that would mean that your security that you are looking at is overvalued. So at the end of the day, the multiple reflects the premium an investor is paying to purchase a security. So that's how you need to look at. So these are the multiples we were looking at, various type of multiples. Just to recap: price to book, price to sale, price to earnings, price to cash flow. These are the multiples that we looked at. Now, what we are going to look at today, before we proceed into the next section, you also need to understand why multiples are used. We also know that there is something else called discounted cash flow techniques. We already discussed about dividend discount model and discounting free cash flow to the equity, FCFE, and arriving at a company's intrinsic value. So we looked at discounted cash flow, and we also looked at multiples approach. And why multiples approach? Multiples approach is widely used. Everybody understands multiples approach because cash flow approach, it is academically more sound, more strong, because that takes into account time value of money. It is kind of a professional way of valuing a company. You are forecasting your cash flows, discounting them to arrive at the value of a company. The notion is that value of a company is nothing but its future cash flows that can be generated until infinity. So that's the logic there, but then there is a lot of complexity. But if you look at price multiples, easy to use. So we say it's widely used, it's readily available because it's based on the market price data, easy to calculate because you calculate this very easily. Anything that you want to calculate is the price divided by the respective metric, whether it's earnings or book value or cash flow or whatever it is. It can be used for cross-sectional or time series analysis, meaning that you can use it for cross-sectional analysis. You can compare one company's PE, price to book value multiple, with another in the industry, or you can use them as a historical time series analysis to see how a particular company's PE ratio has been changing over time. So that's a time series analysis. And people also say that price multiples actually related to equity returns, meaning historically, if you look at the evidence, empirical evidence, as per empirical evidence, that companies with low price to book, low price to earnings have outperformed companies with high price to book, high price to earnings in the long run. So meaning that this is what we call value investing. Value investing is all about looking at stocks which give you great value. What do we mean by that? Investing into undervalued companies. Companies with strong fundamentals, your profitability is good, liquidity is good, the balance sheet position is stable, but you realize that the companies are undervalued compared to their fundamentals. So those investing into those companies is what we call value investing, and some people talk about growth investors. Who are they? Investing into growth companies, right? Now, meaning that now these days, if you talk about growth companies, what comes to your mind is the technology stocks. You talk about Amazon, Microsoft, Apple, and Zoom, and all the things, all the technology stocks comes to your mind, isn't it? So they are growth stocks, but unfortunately, growth stocks are not value stocks, because growth stocks trade at a premium. So they trade at high price to book, high price to earnings, high price to sales, cash flows, etc. But historically, what they say is that value stocks have outperformed growth stocks. So that's what the historical evidence suggests us. So price earnings multiples or price multiples help you to identify undervalued stocks compared to the rest of the stocks in the market. So that way, it is a great tool, widely used by many investors and mostly understood by everybody, right? And these are the common multiples we already spoke about: PE, price to cash flow, price to sales, and price to book value. So now what we are going to look at is that we are trying to say what should be the PE ratio of a company. Now, you know how to calculate PE ratio. We already discussed about it. We are going to divide price of a security, the market price of a security, by the EPS. Market price is the stock market price, and EPS is the profit attributable to one common equity share, which is calculated as net income divided by weighted average number of shares. Now, in this case, so you know what PE ratio, how to calculate them. So what is the meaning of a fair PE ratio? What should be the PE ratio of a company? And this equation helps you to answer that. So what are we going to do here is that we are going to start with constant growth model. Constant growth model, where did we speak about the dividend discount model, constant growth model? What we do, today's share price is based on tomorrow's dividend divided by cost of equity minus your growth rate. So what we are going to do is we are just going to add E1 in both sides of the equation. So what we are going to do is we are going to divide both sides of the equation by E1, and E1 stands for EPS for the next year. So that's your EPS projection for next year. So look what's happening. We are going to divide P naught by E1. So what's that? That's your PE ratio based on your next year's EPS and based on your current price. So you look at this formula, we are going to divide your dividend discount model both sides by the next year's EPS projection. So look what's happening. P naught divided by E1, and on the other hand, you have D1 divided by E1. So what does that mean? You're going to divide your dividend for next year, dividend per share, you're going to divide it by earnings per share divided by cost of equity minus growth rate. So now I have a question for you. What do you think this particular circle means? D1 divided by E1. How do we call that usually? Is there any specific name used for that? How do you call this? D1 divided by E1. Is there any specific name for that? That's exactly right. So this is basically your dividend payout ratio. So you're going to divide your payout ratio by your cost of equity minus growth rate. That is going to give you your PE ratio. Let's take a look at an illustration and understand how this is calculated, and then try to understand more on interpreting the ratio. Look at this. Now what's happening? PE ratio, look at this. You expect a company to pay out 30% of its earnings as dividends. So that's your payout ratio. That's your numerator in your equation. Earnings and dividends are expected to grow at a constant rate of 6%. If you require a 13% return on the stock, and that becomes your cost of equity, what is the stock's expected PE ratio? So now what are you going to do? So your PE ratio equals to D1 divided by E1 divided by cost of equity minus growth, isn't it? That's what we do. So in this case, we know about D1 divided by E1, which is your payout ratio. D1 divided by E1 is your payout ratio divided by cost of equity minus growth rate. So you know 0.3, that's your payout ratio. Sometimes they give you retention ratio, so you need to know if retention ratio is given, how to calculate payout ratio. 1 minus retention ratio is your payout, or 1 minus payout is your retention. So you have your retention ratio, payout ratio divided by cost of equity minus growth rate is going to give you 4.3 times. So what is that 4.3 times? 4.3 times is the PE multiple of this stock. So hope you understand what it means. Okay, now going back to the formula once again, if a company wants to increase its PE ratio, if the PE ratio to be higher for an organization's stock, what should happen? What should happen to your dividend growth, dividend payout ratio, and the growth of the company? What do you think about it? Higher dividend payout ratio, if the dividend payout ratio is more, that's your fundamental equation on this. PE equals to D1 divided by E1 divided by cost of equity minus growth. So you are actually increasing your dividend payout. So based on the dividend discount model approach, because this formula is driven based on the dividend discount model. So this model assumes a company's PE ratio is based on its dividend payout. So higher the dividend payout for an organization, higher the stock value as per dividend discount model. So the same is applicable here. So if this dividend discount model is more, the stock price is going to be more. So higher stock price means higher PE ratio. On the other hand, higher the growth, if the growth rate is more, again, you're dividing it by cost of equity minus growth. A higher growth rate will reduce your denominator in your formula and will increase the PE ratio. Again, higher the growth, higher the dividend payout ratio will increase the PE ratio, and lower required rate of return. What does that mean? If you're talking about a company with less risk, right, that is when you want lower required rate of return on that stock. If you're talking about two securities, one has a higher beta and the other one has a lower beta, the one with the higher beta is going to have higher expected rate of return, and the one with the lower beta is going to have lower required rate of return. So what we are trying to generalize here is that if a company has lower required rate of return, the stock is considered to be less risky, and that should have a higher PE ratio. On the other hand, if you think a stock is going to have a higher beta, that's going to increase the required rate of return, thereby reducing the PE ratio of the company. So based on this model, you should be able to understand how to calculate the PE ratio based on dividend payout for the next year and cost of capital and growth rate. Now, this is an interesting question, and we are actually going to discuss this. Look at this. We are actually going to interpret the PE ratio. Now, if you look at the dividend payout ratio of company is 25, industry is 16%. Sales growth of the company is 7.5, industry is 3.9. Debt to equity of the company is 113. The industry average of debt to equity is 68. So we are actually trying to think here what factors of the company compared against the industry average is going to support the company in having a higher PE ratio. That's our challenge now. Which of these factors support the company having a higher PE ratio than the industry? Let's talk about dividend payout ratio. The dividend payout ratio of the company is 25%. Industry average is 16%. So what do you think? This dividend payout ratio higher than the industry average, is that going to help the company to have a higher PE ratio? Yes or no? What do you think about it? Higher dividend payout ratio? Yes, that is the assumption of the model. Higher the dividend payout ratio, higher the share price. Higher share price would mean higher PE ratio, isn't it? PE ratio is price divided by EPS. So higher price would mean higher PE ratio, isn't it? Because you're dividing the EPS by a higher number. Right, so coming back to the point, so that is supportive. Number two, sales growth is more than the industry average. That would mean the company's growth rate, which you're going to use in your formula to calculate your PE ratio, is actually going to be more, right? What is your formula to calculate PE ratio based on the dividend discount model, which means your PE ratio equals to D1 divided by E1. Remember that this one here is very important. D1 is next year's forecasted dividend. E1 is next year's forecasted EPS divided by cost of equity minus growth rate is going to give you your PE ratio. Now, sales growth, higher sales growth for the company compared to industry average. Is this going to help the company to have a higher PE ratio? Yes or no? What do you think about it? That is again going to have a higher PE ratio. Why? Because this is going to reduce the denominator effect. The denominator value is going to reduce because the higher growth would mean a lower denominator and a higher PE ratio. Number two. Number three, the debt to equity ratio of the company is higher than the industry average. So what does this mean? A higher debt to equity ratio would mean higher financial risk of this particular company compared to the other companies in the industries on an average basis, right? And then that's going to have a higher financial risk, translating into higher beta, translating into higher required rate of return. This stock is considered to be more risky than the average stocks in the industry, meaning that this stock might probably have a higher beta compared to the industry average. So what does that mean? That means the estimated rate of return, the required rate of return of this particular stock is higher than the industry. Would that be supportive of higher PE ratio or no? What do you think about it? No. That's exactly right. Higher PE rate, higher financial risk means higher required rate of return. That's going to reduce the investor confidence on the company, and that's going to be translating into lower PE ratio. So that's what you need to understand. Higher payout ratio, higher PE, higher sales growth, higher dividend growth, higher PE, higher debt, higher risk, higher required rate of return, and lower PE. So this is what you need to know. and we looked at all these price multiples and how to calculate them and how to interpret them. So that's about all the price multiples. Now we are actually moving into something going to be very, very important and very interesting. We are going to talk about a new multiple called EV to EBITDA, right? EV stands for enterprise value. EBITDA stands for earnings before interest, tax, depreciation, and amortization, right? The first thing you need to understand is that in any multiple that whatever we spoke about, price to earnings, price to book, price to cash flow, price to price to book, price to earnings, price to cash flow, price to sales, whatever you look at, your numerator is price. The denominator is the KPI that you are talking about, whether it is earnings per share or book value per share or cash flow per share or revenue per share. But in this particular case, the same logic is applicable. The denominator is going to be EBITDA. But remember, the numerator is not going to be the share price. Instead, it is going to be the total value of the company. What do you mean by total value of the company? Total value of the company is nothing but its market value of equity and the market value of debt. That's the total value of a company. For example, we take the market value of the common stock, which is the market capitalization of a company, right? How do you calculate the market capitalization of the company? The share price times the number of shares. That's going to give you the market capitalization of the company. Point number one. Point number two, we are talking about the market value of the debt. So most likely you will be given book value of the debt in the balance sheet. If the book value is equal to market value, it's fine. If not, if you have a bond which is trading in the market, then you probably need to take the market price of the bond and do a mark to market on your bond liabilities. So you're taking the market value of the bond, market value of the debt, market value of equity, which is the market capitalization, and you're going to deduct any cash and cash equivalents that you have in your balance sheet, cash and short-term investments. That's going to give you your EV. So people can ask you, how EV is different from market capitalization? So what is the difference between EV and market capitalization? It is the debt. In EV, we add the value of the debt. It is pretty much like your capital employed, isn't it? In the balance sheet, I'm sure you remember something called capital employed, where you talk about the equity capital, the total equity, and the total value of the debt. But capital employed is a book value based measure. But here we are actually talking about EV as a market value, right? Market value of your equity, market value of your debt. In all the other multiples, PE, price to book, whatever, we only spoke about the market value of equity. We only spoke about the share price, right? We didn't talk about market value of the debt, because here the focus is the company, not specific equity or debt. So your EV is going to be your numerator. Your numerator is going to be your EV. And remember, your denominator is actually going to be EBITDA. Okay, now the question is, why do you need to use EBITDA? Why not EPS? Well, you can have a question, why not net income or EPS? Why it is so? The reason why you are using EBITDA as a denominator is that because your numerator is EV. And so when you say your numerator is EV, what does that mean? So when you say your numerator is EV, that is the value for the company, both for debt holders as well as equity holders. So your EBITDA, the earnings, should be before interest, should not be after interest. Hope you get that point clarified. I mean, if you talk about calculating return on capital employed, a popular measure, we call them ROCE, we use EBIT as your numerator, and we use your equity capital and debt capital as your denominator, because you use EBIT because you're using equity and debt. But if you look at return on equity, the most popular return on equity, how do you calculate return on equity, guys? You take your net income, you divide it by the total equity, because the equity is the denominator, means you need to identify what is the profit related to equity holders, and net income is the bottom line that is attributable to equity holders, the money that can be used to pay dividends. So when you look at return on equity, it is net income divided by your equity. Yeah, when you talk about return on capital employed, it's your EBIT divided by your total capital employed. Look at that, look at EBITDA from the angle of your ROCE. Why I'm saying that? Because your EV is going to include market value of your debt, market value of your equity, minus cash and short-term investments, divided by your EBITDA. EBITDA represents the earnings to both the debt holders as well as equity holders. So higher the EBITDA means the stock is overvalued, and the lower EBITDA multiple compared to the industry means the company is actually undervalued, right? The logic is the same. EBITDA talks about the multiple on which the company's equity and debt both trades. So we are overall trying to see if the company is overvalued in terms of debt and equity, right? So moving further down into the next slide. Now, when can we use EV/EBITDA? This is a very popular question in the interviews of equity analysts. Like, I mean, if I'm recruiting equity analysts, let's say for an organization, this is probably one of the questions that I'm going to throw at him to see what he answers. I'm going to ask him, okay, what multiple you are probably going to use for a telecom stock? Let's say you say EV/EBITDA. The question is why you use EV/EBITDA for a telecom firm. The best valuation method for a telecom firm to assess whether the stock is undervalued or overvalued is not PE, it's not price to book, but EV/EBITDA. Why is that? EV/EBITDA is very useful for companies which have, which are capital intensive. If you talk about companies with capital intensive like automobile and telco, the right approach, the right valuation metric, right multiple to use is EV to EBITDA, because they got high capex. So when they have high capex, you don't want your earnings to be impacted by a higher depreciation, because if you have high capex, end of the day, your high capex means your depreciation will eat out most of your profits. That is number one. And number two, if you have a higher depreciation, your net income will be lower. And on the other hand, higher capex would mean higher debt. Higher debt would mean higher interest expense. Your net income will be lower due to higher net interest expense and higher depreciation. So you want to measure a company's performance before the debt and before the depreciation. So that's why you're focusing on EBITDA. And the corresponding number comparable to EBITDA is EV, not the market price. And also remember, this is suitable for companies with different capital structure. If one company has a debt to equity ratio of 100% and the other company has a debt to equity ratio of 60%, both the companies have different debt to equity ratios, isn't it? So when companies have different capital structure, your net income is going to be impacted. Why? Because if you have high debt to equity ratio, what's going to happen is that you're going to show interest in your income statement and your net income will be lower. But if you have lower debt to equity ratio, you have less debt, you have less interest, you have more net income, but on the other hand, you're going to have most of the dividends paid out from your equity directly. So it doesn't make sense. So we want to measure the performance of the company without the impact of the capital structure. So we want to identify a measure which is capital structure neutral, meaning that we want to measure the performance of the company beyond the capital structure, ignoring the capital structure, and that is when EBITDA coming into the picture. EBITDA is a measure which measures a company's performance regardless of their capital structure, right? Regardless of their capital expenditure, because capital expenditure would higher the capital expenditure would mean lower the net income because of higher depreciation. Higher debt to equity ratio would mean higher interest expense translating into lower net income. We don't want any of them affecting your net income. So that is why we are focusing on EV/EBITDA for highly capital intensive industries. And also firms in the industry have different capital structure. We don't want to compare capital structure differences and try to say, you know, one company is better over the other. We want to look at the underlying performance of these companies, and that's where EBITDA coming into the picture. And sometimes, you know, we say for telco companies, we use EV/EBITDA. Even at the beginning, you know, if you think about, you know, telco companies, at least for the first 5 years or so, the telco companies, when they start operations, they are going to be in red. The bottom line is going to be in red, at least for the first 5 years, because they are going to have very high capex translating into high depreciation, and then they have high debt and higher interest expenses, and then you have your revenues will be lower at the beginning. So meaning end of the day, you're going to have a negative EPS. So when you have a negative EPS, obviously you cannot use PE, you cannot use dividend payout ratios or dividend discount model, because the companies may not be paying you dividend. So the first milestone for a telco company is to come up with a positive EBITDA. That's going to be the first milestone for a telco company. So that's what we say, that EV/EBITDA is particularly useful in situations where your EPS is negative. If EPS is negative, can you calculate PE ratio? Obviously not. So that is when EV/EBITDA coming into the picture, right? So you need to understand what is EV/EBITDA, how to calculate it, when to use EV/EBITDA. It's a very much widely used valuation tool, valuation multiple to compare, to understand a relative undervaluation or overvaluation of a particular company, right? So let's look at this. So I'm going to ask you questions here. You have a stock price which is $40. Shares outstanding is 200,000. Market value of the long-term debt is 600,000. Book value of the long-term debt is 900,000. Book value of the total debt and liabilities is 2.1 million. Cash and marketable securities is 250. EBITDA is 1 million. So before calculating EV/EBITDA, you need to first calculate EV. EBITDA is directly given to you. 1 million is your EBITDA. So you will need to now calculate your enterprise value. So what is enterprise value? Market value of equity plus market value of debt, both short-term debt and long-term debt, minus cash and marketable securities. So that's how it is. So first of all, what is the total equity value of this company? In other words, what is the market capitalization of this company? So the market capitalization of this company, you got $40 here times the shares outstanding, which is 200,000. So that's going to give you $8 million. So that's exactly right. So it's going to be $8 million. It's going to be your total market value of the company, which is 40 times 200,000 shares. So that is the market value of equity. Now, the market value of long-term debt is given 600,000, which you can add it. However, there is a short-term debt for which the market value is not given. So which would mean that I would assume that the market value of short-term debt and the book value of short-term debt is one and the same. So in this particular case, your book value of long-term debt is $900,000, right? And book value of the total debt and liabilities is 2.1 million. So when you say 2.1 million minus 900,000 book value of long-term debt, that's actually going to give you how much? It's going to give you 1.2 million, isn't it? When you deduct 900,000 from 2.1 million, that's going to give you 1.2 million. What is that 1.2 million, guys? That 1.2 million is the book value of short-term debt. So basically now you got stock price times the shares outstanding will give you the market value of equity. You have market value of long-term debt 600,000. Now we need to understand the market value or book value of short-term debt, which is nothing but 2.1 million minus 900,000, that will be 1.2 million. You can ask me a question, what is the market value of that? You probably don't have it because it may be a bank overdraft, it may be a bank loan for which there is no market value. Remember, the debt will have a market value only when the debt is a bond and the bond is traded in the bond market, then you have a market value. For most of the short-term debt, you need to remember that there is no market value associated. So what we are going to do here is that we are going to take a market value of your long-term debt, 600,000, market capitalization is out there, and then you've got your book value of the long-term debt and book value of the total debt and liabilities. So you deduct 2.1 minus 900 gives you 1.2. So what's your total EV? Right? So we're going to look at the steps in the next slide, but I'm trying to give you an understanding how you can, develop the thought process before you start answering. Number one, market value of your equity, which is the market capitalization, plus market value of your debt, which is your 600,000 of long-term debt, and then the short-term debt. So that's going to be your 1.2 million minus cash and marketable securities, 250,000. So that's going to be your EV. All right, now there is an interesting question. Book value of total debt and liabilities could include current liabilities, because it doesn't say total debt and liabilities. So that's again a good question that you have come up with. So when you talk about the total liabilities, total value of debt in the balance sheet, it talks about book value of the total debt and liabilities. So you need to keep in mind that unless if they say specifically current liabilities, right, then you actually exclude them. But in this particular case, that liabilities could also mean that overdraft. So based on that assumption, we take that short-term debt. We assume that is short-term debt. That's an assumption because there is nothing much that you could do in this question. Right? Hope that makes sense, because there's nothing else that you can do. But I get what you mean, but in this question. That's the best estimate that you can make. So what's happening here? Market value of book value of short-term items is equal to market value. That's your assumption. Book value of your short-term debt is book value of total debt minus book value of long-term debt, which is 1.2, which is what we calculated. So then you are going to have your market value of long-term debt 600 plus 1.2, which is short-term debt 1.8 million total. So step 3, market value of equity, which is nothing but the market capitalization. So that's going to give you 8 million. And then what are we going to do? You have 8 million plus 1.8 minus 250 cash. So don't forget to reduce cash when you are calculating EV. So that's going to give you 9550. So you divide EV by EBITDA. EV is 9550, EBITDA is 1 million. So the company's EV EBITDA is 9.6. So what are you going to do? How are you going to make a decision? You're going to compare this EV EBITDA with a competitor's EV EBITDA or with an industry average. So how are you going to decide whether this stock is undervalued or overvalued? What are you going to do? You're going to look at 9.6 times versus the industry average. And if the industry average is more than 9.6 times, then this particular stock is undervalued. But if the industry average or a competitor's EV/EBITDA is less than 9.6, then this stock is overvalued, right? So again, in terms of decision making in investments, right, for equity securities based on multiples, whether you're talking about price multiples or EV/EBITDA multiple, the decision is going to be the same. The way you look at it is the same, right? Higher the multiple, the stock is expensive. Lower the multiple, the stock is cheaper. But you got to also remember, sometimes if the stock is trading at a higher multiple, maybe there is a specific reason for that. And sometimes if the stock is trading at a lower multiple, then again, there is a specific reason for that. So that's EV/EBITDA multiple. So we are done with multiples approach. The last thing that you need to talk about is asset-based model. I could actually show you how basically the earnings, PE multiple for companies could actually change. Let's go to Yahoo Finance quickly. So look at Yahoo Finance. I'm going to quickly filter a stock. Let's filter Apple, easy to discuss. So you have Apple listed in NASDAQ Stock Exchange, United States. Okay, you see, are you able to see my screen? Are you guys seeing my screen? Yeah. Okay, fantastic. So you look at the last traded price of Apple is $119.99, right? Now, look at the PE ratio of this stock. What is the PE ratio of the stock? Is 32.54. What does that mean? The stock is trading at 32 times of its EPS. And what's the EPS? 3.69. So you probably want to double check if the calculation is correct or your understanding about PE ratio is that right. How can you do? Can you take 119.99 divided by 3.69? Can you see if you are getting 32.54? Does it make sense? Can you look at that? 119.99 divided by your EPS 3.69 gives you 32.54. Is that right? Are you guys following me? What I'm doing is I'm taking your market price, dividing it by the EPS, which is given here. Yeah, so that's approximately the same. So that's your PE ratio here. Now, let me ask you, this looks like a very high PE. Apple used to trade approximately at a PE ratio of 16 times, so 17 times of its EPS. But it looks like the stock is like really, the prices have really gone up. over the last 1 year. Look at the 52 weeks range of the stock. That is very interesting. Look at this. What has happened to this stock? It has traded at a low of $53 and it has traded at a high of $145. So it's been very volatile and it's been going up significantly during the pandemic, right? Pushing the Nasdaq index so much higher because of increase in the stock prices of technology companies, and this is one of those. Look at what's happening. I mean, if you take the lowest price range and can you recalculate the PE, we could see what could have been the PE in the past, assuming your EPS is pretty much unchanged. Maybe it is changed, but pretty much assuming unchanged. So what you think your PE was previously based on a $53 price. So if you take $53 divided by 3.69 EPS, it's 14 times. And this is what I said. The stock used to trade at a PE multiple of 15, 17. So that's the premium investors were willing to pay for a stock like this. But then what happens during the pandemic is that, everybody, started to study from home, work from home. The demand for smartphones increased. The demand for iPads, particularly, Apple recorded highest sale of iPad in the second quarter of 2020, I think, when pandemic was at peak. That was the highest ever iPad sales after 2014, right? So then that explains that there's a lot of positive momentum on the stock. People thought it's going to be the technology stocks that's going to lead the market. So then the stock price went up significantly. And that's why now you are actually paying 32 times of its EPS, but the historical PE multiple is just 16. Okay, now I have a question for you, but just by taking my information into account, what do you think this stock is? Do you think this is overvalued, or do you think it is still undervalued? What do you think about this particular stock based on our discussion? PE is 32 times, historical PE around 15, 16 times. It is actually overvalued. It also depends on what is your estimated EPS for next year. Maybe what's your EPS now? Your EPS for the last 4 quarters is 3.69, right? This is the trailing 12 months EPS is actually 3.69. So 3.69. I mean, let's say, Apple is going to increase its sales. The profits are going to go up. The profits going up by 20%. So which means your EPS is going to go up by 20%. So what's going to be your revised EPS? You've got an EPS of 3.69 now. So, and if you take about 20% earnings growth, what's going to be your revised EPS? Can you guys calculate? Hope you follow me. The EPS is 3.69. So if you apply a 20% EP earnings growth, it becomes 4.43. 4.43, right? That's right, it's going to be 4.43. So can we calculate a PE ratio at the revised PE, at the revised EPS? Take the current price and divide it by your new EPS for the next year. We haven't forecasted, but we're just applying maximum. Let's say you have a 20% earnings growth. So what's going to be your revised PE then? It's going to be 120 divided by 4.43. That's 27. Still it is expensive, isn't it? This is how I look at it. Even if the company generates a 50% earnings growth, let's say the EPS goes up from 3.69 for a larger company like Apple, consistently having a 50% earnings growth from a large number is not possible. But even if you think, okay, the earnings growth is going to be 50% because everybody is going to own an Apple, even in that case, so what's going to happen? 3.69 times 2 is 7.38. So 120 divided by 7.38, it is still 16. So it's going back to its historical multiple at double the PEPS. So what people think, people actually thinking that earnings of this company is actually going to double. So double 3.69 times 1.5, 5.54. Yeah, so it's actually, double. If you take your earnings is doubling, not a 50% growth, but double, then what happens? Your PE becomes 16 times, isn't it? But even if you have a 50% earnings growth, which is going to be 3.6 times 9 times 1.5 is going to be 5.54 will be your EPS. So 120 divided by 5.5, 21.82. Still expensive, but is that realistic that this company is going to have a 50% earnings growth or 100% earnings growth? Do you think it is possible for a company like a large company like this? What do you think realistically? This is common sense, isn't it? Is this possible? If you look at their financials, so that suggests you that there is a technology drive, so that increase the price of these stocks. So if you can go to financials and see their profits, so you will understand what I'm talking about. So this is your P&L, this is their P&L. So they, for the year ended September 2020, right, the company has made a net income attributable to ordinary shareholder. The figures are in thousands. So they made a profits of 457 billion. That's their profits. So, and if you historically look at their profits, what's been happening? I mean, you see 59, 55, 57. Okay, it was 48 earlier. So basically, this is the growth that you have been seeing historically. I mean, even if it's going to grow by 20% more, the stock is still going to look expensive compared to its historical multiple. So that's the story. Okay, going back to, okay, let's look at Zoom, for example. That must be even more funnier. So look at Zoom. You probably see, look at the trading range of this stock. It's been trading over the last 1 year between 108 to 588. So that shows you the madness in the market. The stock price is trading at a PE multiple of 144 times of its price, its EPS. That's the multiple. So look at what multiple Apple is trading at, what multiple Zoom is trading. So it's kind of one of those undervalued stocks, but still people are expecting it to go to 487, the 1 year target. Okay, I have a question for you, right? So I have a question for you. If you want to put the PE ratio of Zoom to 20 times, right? If you want to put the PE ratio of this Zoom to 20 times, right? What should be their EPS? Let me put it that way. What should be their EPS? Currently, their EPS is 2.25. But my question is, if you think the share price is 326, so if you think that this company should, trade at this price and 20 times price to earnings ratio, what do you think their EPS should be? Anybody calculated that? So you think about it, it's just a simple formula. PE ratio is P price divided by the EPS. Anyone else? What do you think their EPS should be if if you want to get a PE multiple of 20 times, currently the PE multiple is PE multiple is 144 times, which is like really high. The premium that you have to pay is really high, which is the madness of investors chasing technology stocks. And this is Zoom is became one of the hot favorites, and it at one point it went to 588. Can you imagine? It went to 588. People even bought at 588, and now it came down to 326 because people started to realize that's not the real value. So that's exactly right. So 16.3 is your EPS that you're talking about. So what if the last 12 months EPS is 2.25? So what has to happen to your net income? What has to happen? What must happen to your net income for you to make sure that this 20 times multiple holds true? Your net income has to grow by how much? 16.3 minus 2.25 divided by 2.25 times 100. There needs to be a 650% growth in your EPS, isn't it? From 2.25 to 16.3 to put the P back to a reasonable level, right? If not, and if you think, okay, let me ask a different question. If you think the EPS of this company is about 5, because they are going to definitely double the profits because many people are using Zoom now. So let's say they double the profit, the EPS is 5. If the EPS is 5 and the PE ratio is 20 times, what should be the share price that this company should be trading? What should be the share price this company should be trading? 100. That's exactly right. So 20 is your multiple and 5 is your EPS, because we are giving room for growth because everyone is using Zoom. Okay, it's fine. Their EPS is going to double at 5. The stock price should trade at 100. It's trading at 326. It should drop down to 100. Okay, let's give them a chance. Let's say your EPS is going to triple. 2.25 times 3 is going to be 6.75. So 326 is 6.75 times 20. I'm trying to do a lot more simulations. 135. Still it is overpriced to 326. So market is actually pricing in an EPS of $16 from 2.25, and I'm not sure when that is possible and how that is possible, taking into account the fact that the company also had to do a lot of upgrades on their information security to accommodate large number of customers using Zoom, and a lot of reported security violations. So they spend a lot of money. So I wouldn't even be surprised if they don't report much profit growth in the quarters to come. That is one. And number two, again, as I told you the other day when we were discussing Porter's 5 forces, this is not a technology that cannot be replicated. It can very easily be substituted by another company, like exactly what happened to Nokia when Apple came in and tapped into this smartphone market. So something could happen. Somebody else smarter than Zoom can come up with an attractive software. I mean, even now you have Teams, Microsoft Teams, and there are various other alternatives available. But if somebody else comes up with a breakthrough on this technology, this company is going to face serious repercussions. So again, what I'm trying to tell you is you've got to be very careful when you're looking at markets. Right, so going back to, so we looked at multiples approach, we looked at multiples approach, we looked at what is the other one we were looking at? Discounted cash flow approach. And now the last thing that we are going to talk about today is asset-based model. right? So in asset-based model, what we are going to do is we are actually going to value a company based on the balance sheet assets. So we are going to look at the net assets of a company. So what is net assets of a company? Is total assets minus total liabilities, which would mean the net worth of the company. So equity equals market or fair value of assets minus your liabilities. And analysts usually adjust asset book values to market values. So sometimes if you feel your assets in your balance sheet are not at fair value, you probably want to do a fair value exercise before you calculate your adjusted book value. And remember, asset-based models offer you a flow level valuation. Always remember this. This is the lowest level valuation for a company. Why? Because there is a lot more than what is on the balance sheet for a company, isn't it? There are so many assets, like human capital is not reflected in the value of assets in the balance sheet. So what does that mean? So that means that your analysts need to also take into account that there are intangible assets in the company which are not recognized in the balance sheet. So that's why we say asset-based valuation models provide a flow value for the company, not not a cap, but a flow. The starting point for you to look at a company's valuation. So if you are looking at a range of valuations for a stock price, you're valuing them dividend discount model, free cash flow to the equity model, then you look at a multiplication of multiples approach, look at all of them, and then look at asset-based value, asset-based models. And asset-based models probably offer you the lowest possible value, right? So let's look at this. Okay, asset-based models. A firm has 2,000 shares outstanding. The market value of net fixed assets is 120% of the book value. They're talking about this net fixed assets that is on the balance sheet. Looks like they have not done a fair value exercise. So they're saying the value here is actually should be 120% of the market book value, so it should technically be more. So you have a total assets of $200,000, and then you have on the other side of the balance sheet, you have your liabilities, notes payable, term loans, and the common equity, and then you have liabilities plus equity of 200,000. So now forget about this 120%, right? Ignoring that, can you tell me what is the net worth of this company? What do you think is the net worth of this company? If I may ask you, the net worth of this company, how much it is? That's right. The net worth of this company is $120,000, which is nothing but your equity value, the total assets minus your total liabilities, so which is given specifically common equity 120,000, which is the share capital plus all the reserves, which they have combined it here and called it common equity, which is 120,000. But now there is a fair value adjustment coming into the picture. So they are actually saying for these fixed assets, the actual value is 20% more. So meaning that you take 120,000. If you take 120,000, so what are you going to do? 120,000. The actual value of the fixed asset is actually 120,000 times 1.2. That is this 120,000 times 1.2. How much that's going to be then? If you take 120,000 times 1.2, that's going to give you 144,000. That's right. So your assets are going to go up to by how much? 24,000. So your total assets will become 224,000, isn't it? Because your 120,000 assets is actually going to become 144,000, which means that your total assets will become 224,000. Where will be your corresponding adjustments on your liability side? If your assets is getting revalued, what should go up on your liability side? Your equity is going to go up, which is the revaluation reserves, isn't it? Revaluation reserves is what that's going to go up. So your common equity, what's going to be your revised common equity? Revised common equity is going to be 144,000. That's exactly right. Okay, now there's a question here. Is it 120% increase? No, you have to read it properly. Here they say the market value of net fixed assets is 120% of book value. It doesn't mean that it's going to, growth is not going to be 120%. Growth is just going to be 20%. Because it's now going to be 120% of what it was. So you have 120, that becomes 144. So the fair value difference is only $24,000, not 120%. Yeah. So that becomes 120 is going to become 144, and that 44 will get added to your common equity. In other words, if you don't want to do that, your assets becomes 224. Your liability stays the same, 80,000. 5 plus 30 plus 45 is 80. So 224 minus 80, again 144. That's your common equity. So either way you do it, look at this market value of your assets. 10 plus 20 plus 50. Those are cash, accounts receivable, inventories, where the book value and the fair value are one and the same. And then the fixed assets, 1.2 times 120, 224,000. Then market value of liabilities is 80,000. 5 plus 30 plus 45, that's 80,000. Then adjusted equity value, 224 minus 80,000. So the revised assets minus 80,000 becomes 144,000. So adjusted equity value per share, 144,000 is your total equity value divided by 2,000. So the book value per share is $72. Now I have a question for you. If you look at in the stock market, what do you think the stock price should be trading? It should be trading at above 72 or below 72. What do you think about it? What do you think about? This is the book value of your equity in the balance sheet. So when you are actually looking at it together, what do you think your stock price of this company should be in the stock market when the book value in the balance sheet is 72? Is it going to be significantly higher or significantly lower, or it is going to be around 72? Remember, we are talking about book value based models. So what do you think the actual stock price of the company is going to be? The actual stock price of this company is in the stock market is going to be what? Is it going to be below 72, above 72, or significantly above 72? Anyone wants to talk about it? It is going to be above 72 because should be above. It should be above. The reason for above is that, you know, there are assets in the balance sheet. There are assets in the company which are not in the balance sheet, like human capital, you know, some form of internally generated goodwill, which are not permitted to be capitalized in the balance sheet. So there's so much assets in the company which is not on the balance sheet. So if you bring all of them, your equity value should significantly go up. But the stock price in the stock market is efficient. So that will take into account all these assets which is on the balance sheet and all the assets which is not on the balance sheet. So when you put things together, the stock price should be technically much more than the 72. But it also depends on industries. I mean, if you talk about technology companies, then, you know, the $72 is nothing because most of their assets is in the form of human capital and knowledge, which is not there on the balance sheet, then the actual stock price may be 5 times of 72. Then the price to book value multiple may be 5 times. You see, we also calculate price to book value, market price divided by the book value per share. That may be significantly higher, like 5 times or 6 times. If we're talking about a technology company, but if you're talking about a bank, then probably your price to book value ratio may be 1.5, 1.6, not more than that, because the balance sheet for a bank fully reflects the total assets of the bank. If not, I think only assets which are excluded is the human capital. For banks, it's not such a big assets, because the core business of the bank is lending money, and loans are part of your balance sheet. Hope that makes sense. So it depends on, again, the industry and how rich your balance sheet is. So this is 72, and this is the flow level value for a company. Now we are going to look at the benefits and issues of different valuation models. Let's talk about present value models, which we discussed at the beginning, dividend discount model, and free cash flow to the equity model. You forecast the cash flows, discount them by cost of capital to arrive at the company value. It is theoretically a sound model, a good method to value a company. It's widely accepted by so many professionals and academically very sound, but the problem is there are so many things that you need to estimate. What are the things that you need to estimate? You need to forecast company's cash flow projections. Discount rate must be estimated. There's so many things that need to be estimated. You need to estimate. So it's subject to bias. If an analyst wants to say a company is a buy, what he could actually do, reduce the discount rate, change the risk premium, or increase the terminal growth rate. You increase the terminal growth rate, your actual DCF model is highly sensitive to the terminal growth rate. You increase the terminal growth rate, end of the day, your model value, the value of the company is going to significantly change, isn't it? You reduce the discount rate, the value of the company is going to go up. If you want to say that the stock is a sell, do the opposite. Increase the discount rate, reduce the terminal growth rate, make your projections more conservative. You're going to reduce the target price of the company, and you can say it is a sell. So end of the day, there is a lot of subjectivity involved in the present value model. Valuation is very sensitive to these inputs. Right, and multiplier models, we know advantages. It's widely used and associated with high stock returns. We said that in the earlier discussion, we said companies with low price to book value multiples or low price to earnings multiples tend to outperform growth stocks. Easily calculated and readily available, good for identifying attractive companies. How would you identify attractive companies? Just a quick question from you. How would you identify attractive company based on multiplier models? How would you identify attractive companies based on multiplier models for your investment purposes? What are you going to do? So till you give me the answer for that, we are actually going to look at, okay, by comparing. That's exactly right. So you are right. So you're going to actually compare the company's multiple with the market average multiple and see if the market, if it is lower than the market average, then it deserves, it is considered to be undervalued, unless if there are any hidden problems, because there are companies who have hidden problems where the liabilities are not shown in the balance sheet or something like that, or a large impairment charge is underway, which is going to significantly reduce your equity value. Otherwise, I would think if you are in the same industry and if your multiples are significantly lower compared to somebody else, then I would definitely think that this stock is attractive from a valuation point of view. So you're exactly right. So you look at, compare with the other stocks, and if you have a lower multiple, you are paying lower premium, so it's good buying opportunity for you. Useful for time series or cross-sectional analysis. We already discussed about it, and we just did a time series analysis on Apple. Remember, we said the P ratio in the past was about 14 to 16 times, but now it's trading at 32 times. So you can look at historical analysis, and cross-sectional analysis is comparing with industry averages and competitors. The problem with multiplier models is that they are vulnerable to your accounting policies. Think about EPS. EPS is vulnerable, right? I mean, you change your accounting estimate, change your inventory valuation, change your depreciation methods. End of the day, your profits are actually going to change. That's going to affect your EPS. So end of the day, it's like garbage in, garbage out. And if your inputs used in preparing financial statements is not reliable, you cannot use multiplier models, because multiplier model heavily relies on your financial statements. And multiples for cyclical companies can be highly variable, because it can go up and down. So what do you think will happen to your multiples during good economic times for cyclical stocks? What do you think the multiples would happen to the multiples in good times? What do you think will happen to the multiples in good times, and what do you think will happen to the multiples in bad times? It will be higher in good times, because they tend to trade at a premium. So they trade at a high. In bad times, it's going to trade at a low time. So you cannot really say what should be the PE ratio for these stocks, isn't it? So that's a problem. Asset-based models, it can give you a flow values, and you can use asset-based valuation mainly for merger acquisition analysis. If you want to acquire a company, this is going to be the starting point. What is the book value? This is where you start your negotiation process. Useful for firm with mostly tangible short-term assets, or if the firm is to be liquidated. If a company with large amount of assets, then this is a good method. And also, this is a good method to use if the company is going to be liquidated. If the company is going to be liquidated, you are going to sell all your assets, settle all your liabilities, and then you are going to identify what is the net asset value of the company, isn't it? So that way, there is no intangible assets which are relevant, because you are not going to use you're not going to operate the business. You're going to just close down, sell all your assets, settle all your liabilities. So your net asset value, the equity value in your balance sheet, is going to be very relevant at that point in time. Disadvantages, the value of the company may be significantly higher than the assets value, because there are so many assets which are there in the company are not on the balance sheet. Number one, that's what they say. Ongoing firm value may be greater than the assets value. Fair value of assets can be difficult to estimate, especially with primarily intangible assets. So meaning, what does that mean? You remember when we did the asset-based valuation calculation, what we did, we increased the fixed assets value by 20%. How did you get that fair value? Maybe the fair values are difficult to obtain in some markets. So that is again a problem, because when you want to use asset-based valuation, you need to first make sure all the assets in the balance sheet are at fair value, isn't it? So that's asset-based model and its advantages and disadvantages. And now what we are going to talk about here is that what method of valuation you should use. As I told you previously, it depends on the purpose of your valuation, depends on what industry you are looking at. Models should be chosen based on the available inputs. I mean, sometimes if you don't have the projected cash flows, and if you don't have the information or capability to forecast, then you cannot use discounted models. Then you have to depend on multiplier approach. Models should be chosen based on the intended use of the valuation. Why are you going to use these valuation multiples? But that's again important. More complexity is not necessarily better. Remember, this is something very important. what many people think, or many analysts think, if you try to make models more complex as possible, it is good for you. And remember, the complexity of model and your outcome of the model is not always positively correlated. One of the reasons why they say the financial crisis happened in 2007, 8, 9, right? One of the reasons that they say is banks used complex models to do stress testing. You know, banks need to do stress testing, and then they use complex models. And so when you use complex models, those models lack explanatory power. You don't understand what's going on in the model because it's so complicated, and at the end of the day, you understand nothing, right? This is one of the reasons for failure, not success. So the lesson for analysts is that don't try to make it more complex, and some form of complexity is important if you want to bring in so many things together, but just making it up, making it look like complex is not going to help you. Consider values using more than one method. I told you this at the beginning. You try to value the company using different approaches and see if the values that you are getting are close to each other. If your valuation is correct, each model cannot throw up a number which is significantly different to each other, isn't it? PE or price to book, price to cash flow, or price to sales. And I'm not going to talk about price to book, because price to book is not really a good method, because that's, you know, you don't have so many assets in your balance sheet, although it is used for banking industry widely, right? Consider the uncertainty about model appropriateness. Consider the uncertainty about input value. So you need to take uncertainty into account. Maybe some analysts handle this by, you know, increasing the discount rates. Some analysts handle this by reducing the terminal growth rate in your DCF, discounted cash flow calculation. So whatever you want to do, if you are an analyst, if you are making a well-informed decision, you are fine to do so. So that's about the choice of valuation model. So let's talk about some of the important things. Okay, now what do you think is the most appropriate valuation method, valuation multiple for automobile company? I'm going to give you three choices. Number one is price to book. Number two, price to earnings. Number three, EV to EBITDA. What do you think is the best multiple for an automobile manufacturer? How do you look at those companies to decide if it is overvalued or undervalued? So you look at EV to EBITDA. That's exactly right. So why you look at EV to EBITDA? You look at EV to EBITDA because it is highly capital intensive. Yeah, highly capital intensive. So that's number one. Okay, question number two. If you are looking at a bank to value, what do you think is the best approach to value, best valuation multiple that you would be using? Is it PE or price to book or EV to EBITDA? Which one are you going to use for a bank? Which one is more relevant? What are you going to use? Price to what? Are you going to use PE ratio, price to book? Okay, price to book. Price to book is more like it, and some people use PE. I mean, not a bad idea to use PE, but price to book is more appropriate. Why do you think price to book? Why do you guys think price to book is inappropriate? Because most of the assets of the company are on the balance sheet. In contrast, if you look at a technology stock, which you don't have much. Right. Now, my next question is, we look at a technology stock. Okay. What do you think is the best approach to value this company? Are you going to use price to book, price to PE, or discounted cash flow models? What do you think is the best approach to value a technology company? PE, price to book, discounted cash flow models. If I ask you to identify the worst, if I ask you to identify the worst model to calculate the value of a technology company, what are you going to say? If I ask you the worst model to calculate the value of a company is price to book, that's exactly right, because these companies don't have much assets, tangible assets in the balance sheet. So you can use PE, you can use discounted cash flows. I would recommend discounted cash flows because which can you can effectively factor in the growth in your projections for the first 3 years. So, and then on the terminal growth, you can apply a higher growth to arrive at the value of this company. So either PE multiple or discounted cash flows can be good. So I'm just trying to tell you, explain you this slide on how to decide an appropriate valuation model. So that's the end of valuation. So we are pretty much done with equity securities. So what we're going to talk about in the next section is going to be full of indexes. We are going to talk about different type of indices, value market, price weighted index, value weighted index, equal weighted index, and various type of indexes we are going to talk about. So I'm going to give you a break now. It's 6:07, so I'm going to see you at approximately 6:22 p.m. All right. Thank you. All right, we're going to get into the last topic in equities, which is market indices. Right, so now before getting into stock market index, we know about stock market indices. The most frequently used ones that we know of are value weighted indices like New York Stock Exchange index. You talk about S&P 500, you talk about FTSE 100 based on London Stock Exchange, and then we talk about NASDAQ index, right? So there are various indices that are used, and most of the indices that are used around the globe are value weighted indices. There are different type of indices depending on how the index is calculated. We are actually going to talk about price weighted index, market cap weighted index, and this is what value weighted index, market value weighted index or market cap weighted index, and then you got float adjusted market cap weighted index, fundamental index weight, equally weighted index, and then we are going to look at illustrations to understand how to calculate index return under each type of methods like market cap weighted return, equal weighted index return, price weighted index return, value weighted index return, etc. Right? So before that, we also need to understand what these indices are. It represents the performance of a market. If you talk about FTSE 100, it's talking about top 100 shares listed in the London Stock Exchange and performance of that. And similarly, any index that you talk about, that is either going to give you an indication about the performance of stocks in a market, or specifically going to talk about some particular sectors, like there are sector specific index, right? You can talk about, if you look at certain stock markets, they have specific indices that talk about there is an index for manufacturing companies, there's an index for banking stocks, there is an index for mining stock, there's an index for telco stocks. So there are indices which can be created for specific sectors, which is used to track the performance of those segments over a time period, right? Index value is calculated from the market prices of index constituent securities. So what constitutes an index? An index is consisting of so many equity securities which are the constituents securities in the index. So if you're talking about a banking index, then you will see all the banks listed in that particular stock exchange will be part of that index. If you're talking about an all share index, all the stock market, all the companies in the stock market will be part of that index. So it depends on the focus, depends on what index that you are talking about. And you should understand, there are various weighting schemes. How are you going to weight your stocks in an index? Are they going to be equally weighted? The first question. If you have 100 stocks in a stock market and the index have 100 stocks, like S&P 500, for example, there are 500 stocks, FTSE 100, there are 100 stocks. How are you giving weightage for each stock? Are you going to give equal weightage, which means every stock will be considered the same in your weighting? Or are you going to weight them based on their respective prices? Or are you going to weigh them based on the market capitalization? That is the most common form of weighting an index is market cap based index. So are you going to use market cap based weighting or price weighting or equal weighting? What weighting scheme are you going to use? That is what this. There are various weighting schemes for constituents, securities, values, and performance. Right. Before getting into index constructions, we will talk about a little bit about returns, price returns, and total returns. If you think about price returns, it excludes the returns coming from dividends or interest, dividends for equity investments, interest for bond investments. So you ignore that. You just only understand the price changes in a security. Let's say you, at the beginning of a period, a stock has a value of 100. At the end of the period, the stock has a value of 110. So during the period, the index has increased by 10%. So the price return is 10%. So what you do, you divide the ending price by the beginning price minus 1, will tell you by how much the price has changed during a period, and the return can also be negative, which means the stock price has actually fallen. Moving on to the second one, total return would mean that we are actually talking about an index price return plus any dividends that you receive on the stock. But when it comes to a bond, we talk about interest. So what we do, you have the ending value, which is the value at which you can sell your stock at the year end, plus any cash flows that you received. It could be dividends or it could be interest for bonds, divided by beginning value minus 1. So now my question to you is, which return is going to be higher? Are you going to see the higher returns on a total return basis, or are you going to see a higher return on the price return basis? You're going to see higher returns on the total return basis, because that's going to include capital gains and dividends. But when you talk about price returns, we are only going to talk about the capital gains. So that's the difference between these two. Again, very easy to calculate returns. Right, now we are actually going to talk about when you are constructing an index, what are the key questions that you need to answer? First, what market does the index represent? Are you talking about New York Stock Exchange or London Stock Exchange? What stocks are you talking about? First question. Which securities will be included? Are you including all the securities in the stock market, or are you including top 100 companies, top 500 companies, top 20 companies? What are you including? Which weighting methods will be used? Are you going to use equal weighting, price weighting, value weighting? What weighting are you going to use? Next question. When will the index be rebalanced? And the next question, when will the index securities will be re-examined? So what does that mean? These two things you need to understand a little bit more. Now, when you talk about rebalancing an index, right, you probably think, okay, your index will have, 20% of your index will be banking stocks, 20% of your index will be manufacturing stocks, likewise. So what could happen over a period of time as the market prices changes? What could happen is that your banking stocks might be more than 20% of your overall index, or your manufacturing might be less than 20% of your overall index, depending on the stock price movements of individual securities. Then what you need to do, you need to rebalance the index. When you say you want to rebalance the index, if your banking stocks have gone up, meaning that it will be more than 20%. So you need to remove some of them and reduce the index back to 20%. And you don't really need to understand rebalancing a lot in level 1. We have an extensive discussion and a separate study session on rebalancing portfolios in level 3. So we don't have that much detail on rebalancing in level 1. Although you need to know what it means. When will the index securities be re-examined? Sometimes you need to move out one security from the index. You need to bring in one security to the index. For example, if you are constructing an index based on top 20 companies in the market in terms of revenue or in terms of your market capitalization, that can change. One company can come into your top 20 and one company can go out. So what you need to do, you need to remove one company from your index and you need to bring another company which has got recently added into your index. So you need to change the constituents of your index, and that's where you will be re-examining your index. So these are the questions that you need to know. How often you're going to do this? How often are you going to rebalance the index? And how often you're going to re-examine the securities that needs to be added into an index. Now, so we are actually going to talk about price weighted index, market cap weighted index. So you just need to remember something. Price weighted index means the weighting of the index will be dependent on the prices of securities, right? Which means a high price share will have a higher weight here and a low price share will have a lower weight, right? I mean, if you remember, some time ago, we were looking at the share prices of Zoom Technologies, which was trading approximately around $336, and Apple is trading at $120. And now in a price weighted index, my question to you is, out of these two stocks, Apple and Zoom, which one do you think is going to have a higher weightage? Which stock? Zoom is going to have a higher weightage because you're going to weigh the stocks not by looking at the market capitalization. You're just going to look at the share price, right? Fortunately, NASDAQ index is value weighted. S&P 500 is market cap weighted. NASDAQ is market cap weighted. And I mean, remember when I say value weighted, market value weighted, I mean market cap weighted, because market value and market cap is one and the same thing. I mean, in terms of, the theoretical, soundness, I would actually prefer a market cap weighted index versus price weighted index, because the price of companies, right, cannot be compared against each other, because it depends on, if you like, how you cut a cake. You can cut your cake into 100 pieces, you can cut your cake into 50 pieces, depends on how you cut a cake into shares. That's how your shares are divided in a company. So you have higher number of shares, you lower share price, and you have lower number of shares, higher share price. In absolute terms, if you just look at them and compare between companies, it doesn't make sense. And that's why we always look at price to earnings, we look at price to book, we look at price to cash flows, because we cannot just compare one company's price with other company's price, isn't it? End of the day, it doesn't make sense, because it depends on how they cut their cake, right? So coming back to this, so why I'm trying to tell you is, from an academic soundness perspective, maybe price weighted index does not really make a lot of sense. What's going to happen? Low priced items will have a lower weightage, high priced items will have a high weightage in this index. When we do the sums in a while, then you will understand this much better. Great example for price weighted index is Dow Jones Industrial Average and Nikkei Dow Jones Average are great examples of price weighted indices available in the market. Moving to market weighted index, which I particularly like. So this is based on the market capitalization of companies. So how do you calculate the market capitalization of companies? Share price times the number of shares. Yeah, so we're going to multiply share price times number of shares, market cap. So in that particular case, what are we going to do is, we are going to give higher weightage to companies with large market caps and lower weightage for companies with lower market cap. So this index will be more sensitive for changes happening in large companies' share prices. If you look at Apple, is as a size, in terms of market capitalization, the value is $2 trillion, isn't it? So that's like significantly higher than Zoom, for example. So in a market cap weighted index, which stock do you think is going to have a higher weightage in your market cap weighted index? Apple is going to have a higher weightage, because this is significantly bigger in terms of market capitalization. A small change of Apple is going to significantly change your NASDAQ index, because this is a high cap stock. So we can actually divide stocks into high cap, low cap, and mid cap. High cap means bigger companies with large market capitalization. Low cap means smaller companies with small market capitalization. Mid cap is something in between high cap and low cap, large cap and low cap. So you go to large cap and small cap. So you large cap, small cap, and then you have mid cap in between. So market cap weighted index is highly influenced by high cap stocks. So look at this. What they are saying is, firms with larger market caps influence the index more than firms with smaller market caps. Momentum tilt. Overpriced stocks have higher weight in value weighted index. That's very true, isn't it? I mean, if a stock is overpriced, what do you think their market capitalization is going to be? What do you think their market capitalization of overpriced stocks? If a stock is overpriced, what do you think their market capitalization is? Overpriced means overvalued. Yes, it is high. It is high. So if it is high, then they are going to have a higher weightage in your index, right? So popular market cap weighted index are S&P 500, Wilshire 5000. They are popular ones. Also remember, most indices are actually market cap weighted index. Right, now remember, this is very important. You don't get mixed up. Market cap weighted index and float adjusted index weights are both derivation from market cap weighted index. So in other words, market float weighted index is a derivation from market cap weighted index. So remember, it is not an altogether a different stock, a different index methodology. It is the same like market cap. The constituents of the index is weighted based on the market cap, but you need to make some adjustments. What adjustment? You are going to make a float adjustment. What is the meaning of float adjustment? Is that you need to, if you look at any stock market, if you've been trading in the market, you would probably know what is the meaning of float. Now, the thing is, if you, the good example that I can give you is, let's say, if you take Ooredoo, for example, in Qatar markets, if you take Ooredoo, for example, you got, you know, a significant portion of the company is owned by the government, right? So that particular stake is not traded in the market. So it's not part of the float, right? When you say float, that's the market. So it's actually not really floated. It's tightly held by government institutions, or you can take about any stocks, for example, any stakes owned by the parent companies or the government or institutional investors. They are not really traded, right? Those stocks are actually excluded from market float weighted index. So in a market cap weighted index, you will include everything. You will include any sort of stake. If a company has 1 million shares, you just take all the 1 million shares times the share price. But market float weighted index is a better measure if you are talking about certain companies where large number of shares are not really trading. So you exclude them and you only look at, calculate the market cap based on the share price of the company times the float. Float is the number of shares which can actually be traded in the market, which are floated in the market. So you've got to be very careful here. Index with number of shares equal to investable shares. Can you go and invest? If you want to buy shares in Ooredoo, in the Doha Stock Exchange, in the Qatar Exchange, if you want to buy Ooredoo shares, can you go and buy the government stake? Is that possible? Can you go and buy government stake straight away? No, you can't do it because it's tightly held. They are not selling it. So you can only go and buy whatever available in the market, isn't it? So that's where the float adjustment comes into play. You remove some stocks from number of shares which are not investable, which are not tradable. So that's what we do in terms of market float adjustment. Index with number of shares equal to investable shares excludes shares of controlling investors, and often those held by government or corporations. Free float index, when shares not available to foreign investors are excluded. So remember, there is also something called free float index. When shares not available to foreign investors are excluded, which means if you take certain countries, they have a cap on foreign shareholding, right? You know, in some stock market, they say foreigners cannot own more than 49% on any single company in the stock market. In that case, yeah, only that 49% which can be owned by the foreigners will become free float index. The rest of it, rest of the investments, 51% in that case, has some sort of limitations in it. Foreigners cannot trade on it. So this is called free float. So free float means when shares not available to foreign investors are excluded. So what you will consider in this index is only the shares that are available to foreigners. So that's probably a better indication of market liquidity. Right, fundamental index weights. This is interesting since now we have done valuation of companies. So this makes more sense to you now. So when you talk about fundamental index weights, when do you think a company is considered to be undervalued in terms of multiples approach? Can you think about it? Always better that we bring back what we learned earlier into perspectives when we discuss some new topics. So what do you think about it? When do you think from a multiples approach a stock is undervalued? When do you think a stock is undervalued from a multiples perspective? When you talk about price to book or price to earnings or whatever the multiple that you're talking about, when do you consider the index, the stocks are undervalued? the multiples of the average is higher. Industry average is higher, isn't it? The multiple of the industry average is higher compared to the stock. That's when you consider it to be undervalued. So in a fundamental index weight, remember that you give a higher weighting to undervalued stocks. You give higher weight to undervalued stocks. So which type of stocks you will give higher weighting? Companies with lower price to book, companies with lower PE, companies with lower EV to EBITDA, you are going to give a higher weight in the index. So your index will be biased towards undervalued stocks, which is good, right? So it leads to a value tilt. So what does that mean? Your index is going to be biased towards undervalued stocks. That's what we call a value tilt. What do you mean by value tilt? Means your index will be more skewed towards value stocks. What are value stocks? Value stocks are stocks which trade at lower price to book, lower price to earnings, lower EV to EBITDA, and things like that. So look at it, leads to value tilt. High book to markets have higher weightage compared to value weighted. Look at this. What do you mean by high book to markets? You don't get confused. Sometimes they say only for the book value you get this confusion. Sometimes they say low price to book value, which is cheaper. But if you look at it here, they are talking about high book to market. I mean, this is obviously the same thing, isn't it? Book to market means book value divided by market value, isn't it? So low price to book is same as high book to market. So it's the same thing. So don't get confused here and start thinking, okay, we are going to have high price to book, higher weight. No, we're going to give a higher weight to low price to book. But here they are writing it differently. If you see high book to market. Book to market means book value divided by market value, which is the opposite of, which is the upside down of price to book. So price to book is lower, means book to market will be higher. So you've got to remember that. So in this index, which stocks is going to have higher weightage in simple terms? Fairly valued stocks or undervalued stocks or overvalued stocks. Which stocks do you think is going to have higher value? Fantastic. Undervalued stocks are going to have higher weightage in a fundamental index weight. Also, you need to understand there are certain indices which we call multi-market indices. So let's say I'm going to create a multi-market index based on 5 countries. I'm going to create an index. I'm going to pick companies listed in different stock exchanges, create a multi-market index, and how am I going to give weighting for each country? I might give weight based on the GDP of the country. So if the GDP of a country is more weightage for them. Lower sized economies with lower GDP will have lower weight in the index. So GDP weights are usually used in multi-market indices. Equally weighted index. So what are you going to do? I mean, you we spoke about Apple and Zoom, so I'm bringing them back every time so you understand better. So in a price weighted index, if Apple is trading at $120 and Zoom is trading at $336, which stock is going to have higher weight in price weighted index? In price weighted index, which stock is going to have higher weight? Apple or Zoom? Zoom is going to have higher weight because it is trading at a higher price, 336. Second question. In a market cap based index, which stock is going to have a higher value? Apple or Zoom? Apple is going to have a higher value. Why is that? Because Apple's market capitalization is significantly higher than that of Zoom. The third question for you, in terms of fundamental weight index, which stock is going to have higher weightage? If you are creating a fundamental weight index based on how undervalued or overvalued stocks are, then which stock is going to have a higher weightage, Apple or Zoom? Which one is going to have a higher weightage? In fundamental weighting, I think I slightly touched base on the PE multiples of these two companies, isn't it? If you remember the PE multiples of these two companies, so which company has relatively lower price to earnings ratio? Apple has significantly lower, 32 times versus 100 odd times of Zoom, isn't it? That doesn't make sense. Right, so obviously Apple is going to have more weight there. Okay, in an equal weight index, what's going to happen? Who do you think is going to have a higher weight? In equal weight index, who's going to have higher weight in equal index weighted returns? All the stocks in the index is going to be equally weighted. Then none of the stocks is going to have a higher weighting. Every stock is going to have equal weighted, and most of the times, equal weighted indexes are rebalanced quarterly. So you've got to remember that. It depends on the other one, you don't specifically say, but most of the times equally weighted index is quarterly rebalancing is needed. Right, now this is the summary of what we discussed, and now we are going to also look at the questions. Then things become much more clearer when you look at illustrations and how you look at index returns. In most of the exam questions, you might get the concept checkers like what we discussed now. You might also get some calculations on the index, so you've got to be familiar with both. Right, now look at this. This is an interesting slide. We are actually going to talk about each of them. Compared to a market cap weighted index. We are comparing all these index based on the market cap weighted index. Why do you think we are comparing all of them with market cap weighted index? Why is that we are doing? Why are we comparing everything with market cap weighted index? Because market cap weighted index is the most popular index available, right? The first one, price weighted index. Compared to market cap weighted index, a price weighted index places more weight on high price stocks. Do you agree with me? Compared to market cap index, a price weighted index places more weight on high price stocks. Is that right? Do you agree with me? Yes, because if you think about price weighted index and market cap weighted index in versus Apple and Zoom, price weighted index, as we said, will have more weightage for Zoom because that's a high price stock. Hope you get that point. Stock splits change all weights. I will explain that in the next example. Equal weighted index. So when you compare with market cap weighted index, equal weighted index places more weight on small cap stocks and less on large cap stocks. Must be rebalanced. So you need to understand, if you talk about equal weighted index, that has to be rebalanced, and that's why we say equal weighted index rebalance often quarterly. So going back, if you say equally weighted index places more weight on small cap stocks and less weight on large cap stocks. Obviously, why? Because if you talk about a market cap index, market cap based index, it's going to give a higher weightage to bigger companies and lower weightage to smaller companies. But if you look at equally weighted index, it's going to assign similar weight to identical weights to all the stocks, which means who's going to benefit? Can you think about it? Who's going to benefit in terms of weight? Are the small companies going to benefit or large companies going to benefit in an equal weighted index? Small companies are going to benefit. They are going to have a higher weightage. That's what they are trying to say. that needs to be rebalanced. And how often you rebalance them? Quarterly, most of the time. Float adjusted index, market cap weighted index. So when you are comparing a market cap weighted index, a float adjusted index more closely matches investable shares, obviously. But you should understand something. Is your float adjusted index, is this a price adjusted index or price weighted index or equal weighted index or a market cap weighted index? What it is, a float adjusted index, what it is? It is market cap based index, but only thing is you are going to remove some of the, what are you going to do? You're going to remove uninvestable shares, tightly held shares which are not traded in the market. You're going to remove. By the end of the day, how are you going to calculate the value of a stock? The number of shares available in the market or investable times the share price. So we are going back to market cap, but the market cap is adjusted to reflect the float. Hope that makes sense. The last one, fundamental weighted index, has a value tilt. So what does that mean? If you are compared to market cap weighted index, your fundamental weighted index has got a value tilt. It's biased towards what type of securities? It is biased towards overvalued securities or undervalued securities? It is biased towards undervalued securities. Are going to have a higher weightage compared to overvalued securities. Fantastic. So we are in slide 44. Now we are going to look at each of these methods we spoke about, different indices. Now we are going to look at this, and this is going to make more sense to you now, and it's going to make things a lot more clearer now. So this, we are going to calculate price weighted index. So what's going to happen to price weighted index is that so you look at the price as of 31st December 20x6, 31st December 20x7. So what is the price movement? What is the time period between these two price movements? We are looking at a 1 year movement on the index. So in the first one, A is trading at $10. A has gone up to 20. B is trading at 20. It's gone down to 15. C was trading at 60. It's gone down to 40. So in terms of price weighted index, what are you going to do? You're going to add all the prices of stocks last year, which is 10 plus 20 plus 60 gives you 90. See what's happening. 10 plus 20 plus 60. 90 divided by 3 because there are 3 stocks. If there are 100 stocks, you add all the stock prices of 100 stocks divided by 100. You're going to get a price of 30, and then you are going to have the next year prices 20 plus 15 plus 40. 75 divided by 3, 25. So what is the price change? What is the index return? The index return is negative. Index return is fallen from 30 to 25. What is the fall? Index return falls by 5 divided by 30 times 100. 5 divided by 30 times 100, how much is that? That's going to give you approximately 17% reduction in your index value, 16.67. So hope you understand how we do calculation on a price weighted index. Add all the prices divided by number of securities in the index, compare it with the next period value. So now, can you answer me this question? Which stock has got the highest weight in this particular case? Which stock has highest weight in this particular case? C. That's exactly right. Why do you think C has a highest weight? Why do you think C has a highest weight? Because it is highly priced. Now, this is more interesting. Look at what's happening to A. A price has doubled, but B has fallen down only by 25%, and C has fallen by only by 33%, but A has increased by 100%. But increase in the A by 100% did not help the index much. So the index suffered a decline of 16.67%. So now question to you is that, why do you think it is? The increase in price of A from $10 to $20 did not really help this index to increase its value. Why is that? Why is that? A has doubled from 10 to 20, but it didn't have a much impact because it got a less weightage in the index. Why it got a less weightage in the index? Because it got lower price, because we are talking about a price weighted index. So you got to remember that. Right? So it's important that you understand this. Right, now I'm ignoring this question for the moment and I'm going to come back to this later, right at the end of today. So now I'm going to talk about market cap weighted index. So what do you mean by market cap weighted index? You're going to weight your stock based on market capitalization. So look at this A, B, C. There are three stocks. A 100, price, B 10, fee 1. The number of shares 100,000, 1 million, 20 million. So you see the relationship. If you have a higher number of shares, the share price will be lower. And if you have a lower number of shares, the share price will be higher. This is what I told you. You cannot compare the share prices of companies directly. So you calculate the market cap. So how do you calculate the market cap? The share price times the number of shares. Share price times the number of shares. You do that. So you take A, B, C. A is 10 million, B is 10 million, C is 20 million, 40 million. This is as of last year. So this 40 million is your base period market cap. So you assume this is 100. Let's assume this is 100. So 40 million is basically 100. So now the question is, calculate the capitalization weighted index if stock A price doubles, if stock C price doubles. First, let's understand stock A price doubles. Okay, stock A price doubles. So from this index perspective, is it a low weighted stock or high weighted stock? What do you think about it? Stock A, is this a high weighted stock or low weighted stock? It is actually a low weighted stock because it got a market cap of 10 million. What is the high weighted stock? What is the high weighted stock? Okay, now even before you calculate anything, you can tell me which one would have a higher impact on your index. Change in the stock price of C is going to have a higher impact on the index because in terms of market capitalization, that got the highest weightage. Fantastic. So you guys are awesome. I don't have to explain much. So look at this A, B, C. You got your share price 200 times 100,000. Your market cap is 20 million. Why I'm increasing? Because I'm increasing that from 100 to 200. Everything else remains unchanged. So the market cap of B and C remains unchanged and you've got a total of 50 million. So now we are going to say now 40 million is 100. 100 is 40 million. So what about 50 million? So 100 is 40 million. So 100 divided by 40 times 50. So your new index will be 125. Hope you got the point. We assume the previous period in market cap of the market as the base, which is 100. So 100 divided by 40 times now 50. So that becomes 125. So what does that mean by 125? So when you say 125, we're talking about 125. So that means that there is a 25% growth in the index, isn't it? 100 becomes 125. So how you calculate the growth? 25 divided by 100 times 100 in terms of percentage. The stock market increased by 25%. Okay, now we are going to calculate the stock C is doubling 2. So it was $1, it's becoming $2 now. So it becomes 40 million. 2 times 20, 40 million. So you recalculate your index value. What is your index value now? 150. Because now in this table, we are assuming that the stock C doubles. Isn't it? So stock C doubles, and that's going to have a higher impact on your ultimate index because stock C has a higher market capitalization, resulting in a higher weightage in a market cap weighted index. So your index grows by 50%, 100 to 150. Does this make sense? Yeah. Do you get it? Are you guys there? Does it make sense? You understand how this works? All right, fantastic. So, okay, now let me ask you one more question. Now, this explains, there is a big disparity between these different type of indexes, isn't it? Because if you look at stock A and if you compare it with stock C, in a price weighted index, which stock you think is going to have a higher weightage in a price weighted index out of these three? Out of these three, which index you think is going to be weighted more? Stock A is going to be weighted more, but out of, so which stock is going to be weighted so less in a price weighted index? In a price weighted index C, and that is the same stock is going to be weighted significantly higher in a market cap based weighted index. You get it? So different indices, depending on how you calculate them, what weighting method you use can throw up different numbers to you. So you got to be able to recognize that different indices have different things to offer, right? So now that's about this. So we are done. So we are actually going to talk about what now? We are going to talk about equal weighted index, and before that I got a question. I spoke about price weighted index, I spoke about value weighted index. I'm asking you a different question now. So now the question is, if you are talking about a fundamental weighted index, which stock is going to have more weighting? Stock A, stock B, stock C, or you don't have enough information to decide? What do you think is the right answer? Is it stock A or stock B or stock C, or you don't have enough information to decide in terms of fundamental weighting? You have no information, not enough information to decide, because if you want to know which stocks are undervalued or overvalued, you need to know the PE multiples of the company versus industry. So much other information you cannot decide. Right? Sometimes the questions can come up on this way in the exam as well. Right, so moving on to equally weighted index. So what's happening here? You have three stocks. You have an initial stock price 12 going up to 15, stock B 52 going down to 48, stock C 38 going up to 45. So what we do here is that we identify the holding period return of these stocks separately. Stock A, what is the holding period return? What do you mean by holding period return? Is the ending value minus the beginning value divided by the beginning value times 100. That's going to be your holding period return for that stock. So what's happening to stock A? 12 to 15 is grown by 25%. What happened to stock B? It was 52, came down to 48. So it's gone down by 7.7%. If you look at stock C, what's happening? It was 38. And it's gone up to 45, it's grown by 18.4. So then what we are going to do is we're going to get an arithmetic mean. Arithmetic mean is a simple mean. Yeah. So we just add all of them. 25 minus 7.7 plus 18.4 divided by 3. So that's going to be your average return of a stock in the market, equally weighting them. Why equally weighting? Because we are dividing it by 3. So that's equally weighting, right? So 3, 11.9. So what we're going to do is look at this. Your previous index value, they're talking about initial index is 131. So now the average growth of the index is 11.9. So you might ask me, okay, what is your revised index? Your revised index is 131, the previous index, times 1.119. What is this 119? Is that 11.9% growth. So it will be 131 plus 131 times 11.9. So how much is that? 131 times 11.9% gives you 15.59. So that's what 131 plus 15.59 is going to give you 146.59. So that's your current index value. All right, hope that makes sense. So that's the equally weighted index. And so we are now here in slide 151, and before that I want to explain something more to you. Remember, I said I'm going to talk to you about this. Now the problem is when you are talking about indices, you need to understand if there are stock splits, what will happen to stock prices when there is a stock split? What do you think is going to happen to your stock price when there is a stock split? What will happen to the stock prices when there is a stock split? Price gets adjusted. So what's going to happen? The price is going to go down or the price is going to go up? What's going to happen to your stock prices? Your price is going to go down. It's going to go down, isn't it? Because there is no money coming in. So when there is a bonus issue or stock dividends, you call it stock dividend or bonus issue, it's the same thing, or you come up with a stock split, the price is going to go down. Let's say, for example, stock A. Okay, they are splitting the shares. Okay, let's forget about stock A. Think about stock C. Stock C is splitting the shares for 2 for 1. So everyone is becoming 2. The stock is becoming double. So what's going to happen then to the share price? The stock is going to get double. So what do you think will be the revised price of this stock C? If you look at on 60, it will become what? It will become 30. It will become 30. So which means if you think this is going to be 30, and then you are actually going to show that in the next period, the stock price is actually 40. So which means the stock price has actually fallen, but in the index, it's going to show that it's rising because we are actually calculating based on the price weighted index. So the problem with the price weighted index is that it does not automatically account for bonus shares or stock splits. You have to manually adjust them. But think about market cap based index. Go to market cap based index here. Think about this. For example, let's say share price of A, it's getting split 2 for 1. So what will happen to the revised number of revised share price? What do you think will be the revised share price now? It was 100. I'm not talking about the market cap, but in terms of share price, what's going to happen to your share price if there is a share split? 2 for 1. It is getting split into 2. What's going to happen to the share price? The share price is going to be 50. But what's going to happen to your number of shares? What's going to happen to your number of shares? The shares are going to go up to 200,000. Share price is 50,000. Market cap remains the same. So what does that mean? A market cap weighted index automatically adjusts for stock splits and bonus shares. Do you agree or disagree? A market cap weighted index will automatically account for stock splits because the number of shares stay changing, price changing, the market cap doesn't change. And remember, this is what we said previously, that changes in the number of shares through a share split or bonus shares or stock splits should not have an impact on the value of a company. Isn't it? Hope you remember that learning outcome statement now. So now if I go back to here, so now we are going to actually tell you how we are going to adjust your index for stock splits in a price weighted index. So because price weighted index is going to throw a wrong data if there is a stock split. So we need to fix that. So how are you going to fix it? Stock A is 10, stock B is 20, stock C is 90. Your index value is 40 because 90 divided by 3. Stock C splits 2 for 1. What is the new denominator for the index? So what's happening to stock C is becoming 2 for 1. So what would be the revised price of stock C? Can you tell me what would be the revised price for stock C if there is a 45? Okay, now this 10 plus 20 plus 45 divided by 3. What will that give you? Can you do that maths for me? If you take 10 plus 20 plus 45, 75 divided by 3, how much that is giving you? 25. So is this a real decrease in the share price, or is it because of the share split? Is this because of the share split, or is it because of the real reduction in the share price? It is because of the share split. So what we do is we need to keep the base period index at 40, because that was the index before the stock split. So what you need to do is we need to change the base number of stocks you're going to change. So 10 plus 20 plus 45 should give you 40. So if you use 3, because there are 3 stocks, you won't get 40. So you won't get 40. So by how much you need to reduce this 75 to get 40? You need to divide it by 1.875. So you're going to divide you're going to change your base number of stocks from 3 to 1.875 so that your base period index remains 40. That's what you do to adjust price weighted index for stock splits. And you don't need to adjust market cap weighted index or any other index, equity equal weighted index. You don't need to adjust. Right, now we are actually talking about rebalancing and reconstitution. Remember, I spoke about it earlier. Rebalancing means updating the index weights on a periodic basis depending on your mandate of the index. Reconstitution is periodically adding or deleting securities. Remember, in rebalancing, you don't bring in a new security or you don't remove an existing security. You play around with the weights of the existing securities. You may be increasing, you may be decreasing, but you don't bring something new. In reconstitution, what happens? You periodically add and delete securities. When will you practically think about it? If you think about, if you are talking about, FTSE 100 index, it talks about top 100 London companies in England were listed in the London Stock Exchange. So if some company falls out of top 100 list, you need to remove that and bring new one in. That's what reconstitution is. But that's not rebalancing. So you need to understand. I mean, you don't need to understand very much deep in detail because this is in level 1. In level 3, we talk about rebalancing more in depth. Right? So that's about rebalancing and reconstitution. Now you need to understand what we are going to talk about in usefulness of indexes, why it is used, reflection of market sentiment. If the index is going up, why it's going up. Now it's been going up, right? In the United States and everywhere else, the stock markets were going up contrary to what was happening into the economic fundamentals were weakening, unemployment was rising, but the stock market was going up, right? So why? Because there's a lot of hope on stimulus, whether the governments will bail out the economies, and there were a lot of hopes on vaccinations and things like that. So, and also a lot of people who lost their employment income and you lost other type of income now thought the only way to make money is pushing the market higher, isn't it? That's another way to explain why the market went up. It tells you who drives the market. It's the key players in the market who drive it, isn't it? All these institutional investors. So they have no income now because everything else was going down. So let's push the prices up make money out of it. So that's another way to look at it. So in end of the day, you know, your index reflects market sentiment, whether the market is bull market or bear market. Bull market is a market that goes in going up, upward trend. A bear market is the one that keeps coming down. Performance benchmark, you know, sometimes if you want to measure a portfolio manager's performance who's trying to create alpha, what you can do is you can give him a benchmark to him. If you are giving your funds to your portfolio manager, you tell them your benchmark is the return that you generate on my portfolio after deducting the fees and commissions should be more than S&P 500, or should be more than FTSE 100, should be more than NASDAQ index. It depends on what you index you are looking at, but it can be used as a performance benchmark for a portfolio manager to decide a portfolio manager is outperforming an index or underperforming an index. If a portfolio manager has made a return of 15%, but the market return is 10%, then the portfolio manager has outperformed the index. But if the portfolio manager has generated a 15% return, but the market return is 20%, then the portfolio manager has underperformed the index. It's a measure of market return. If you think about going back into your CAPM formula, CAPM, you have risk-free return plus the market rate of return minus risk-free return times the beta. In that, the market rate of return can be this index return, right? To calculate the beta, we use indices. Calculate expected and risk-adjusted returns, model portfolio for index funds. If you have index funds, you know, various indices for different funds, you can create a model portfolio for benchmarking purposes. How would you benchmark your index funds, their performance against an index? So you can use indices for that. There are many uses of indices. And there are type of indices, you know, broad market indices. We spoke about various weighting schemes, price weighted, value, market cap weighted, fundamental weighted, various weighting, equal weighted, things like that. Multi-market cap indexes, we said it is weighted based on GDP. Multi-market, market cap weighted, but the country weights may be depending on the GDP. And then, you know, in multi-market, you have market cap weighted, and in multi-market, you also have fundamental GDP weighting. Right, so multi-market weighted. What do you mean by multi-market? Means you are going to form an index and you're going to select securities from different countries. And if you are going to assign weightage based on the market cap of those respective companies which you are adding into the index, is the multi-market market cap weighting. But when you say multi-market with fundamental GDP weighting, the country weighting in your multi-market index will be dependent on the country's GDP. So which means you would have now the question is, so which countries are going to have higher weightage in multi-market with fundamental weighting index? The countries with high GDPs is going to have a higher weightage. There are sector-wise index, healthcare, technology, finance, consumer goods. So you can look at which industries have increased during a period, which have gone down. Style indices, you can have a large cap index. So in that index, you have the index constituents will be large cap companies, mid cap companies, or the medium sized companies will be there. Small cap companies will be there. So you can construct an index consisting only small cap stocks. You can create an index only with mid cap stocks, or you can look at value versus growth stocks index. You can have one index where you can include value stocks. What are value stocks? We are at the end of equity securities, so it's important that we recall all what we studied now. What are value stocks? When do you think a stock is a value stock? What is a value stock, guys? A value stock, what it is? When you think a stock offers you significant benefit as a value stock. Exactly, the stocks which are underpriced, they are value stocks. That's exactly right. So they are value stocks. And then what are growth stocks? Those companies who are going to have significantly higher growth over the others, like technology stocks. Now they are growth stocks. So you can have indices for value stocks, growth stocks, things like that. So there are different indices. So there are fixed income indices, which we will talk about it in fixed income securities, bonds. Fixed income is bonds. So you can have indices based on the country type, region, based on the collateral sector. You can have them. The problem with the fixed income indices is illiquidity, because equity markets are more liquid and more investable than the bond markets. So the problem is pricing data and illiquidity, high turnover. We will talk about this in bond fixed income securities when we will talk about it. I will touch base this. And then alternative asset indices. Okay, what are alternative asset classes? What are alternative asset classes, guys? What are alternative asset classes? Real estate, commodities, things like that. So this is an index which measures the performance of alternative asset classes. There are commodity indices which measure the performance of gold and silver, platinum, etc. Different commodities will have different weights. Real estate indices are there. You know, you have REITs, it's a popular real estate index. There are hedge fund indices. So don't worry about them. There is a separate study session called alternative investments in level 1. We will talk about this there, and we will talk about this in the fixed income a little bit more in detail. Right, and from slide 156, 157, 158, 159, all the way up to 160, you have different type of popular indices there. So you talk about Dow Jones Industrial Average, 30 stocks are there. It's a price weighted index. Nikkei stock average, it's a large Japanese stocks, 225 stocks. Topics, all stocks in the Tokyo Stock Exchange. Right, this is variable, but weighting method is market cap based. So you can look at all of these indices, right? And you know, I just don't really recommend you memorize them, but just read them, gather a good understanding about what type of indices are available, and you might sometimes be asked in the exam, is Nikkei a value weighted index or price weighted index? Things like that can come up. Maybe one question max can get tested on that. So it's not a bad idea to just go through them on your own time and understand which stocks are value weighted, which stocks are price weighted, and how many constituent securities are in there, and things like that. So that's the end of this particular section. We got a miscellaneous section at the end, which I will be discussing on Wednesday before we start fixed income securities, where we are going to actually talking about market efficiency in that. So we got about how many slides? And we got about 7 slides, 10 slides. Yeah, we got about 10 slides. So we start with this, and then we look into fixed income.